Hello everyone, welcome back to the channel. Today's video is going to be my 2023 introductory guide to investing in stocks. This will be the first in a series of 2023 guides that I'll be releasing over the course of the next few weeks. My objective for this series is to provide you with clear, concise, step-by-step guides that will set you up for investing success in the decades to come. In this first guide, we're going to talk about what investing is, what company stocks are, why they're valuable, how you profit from owning them, why investing is important, and when's the best time to start investing. Just a bit of background on myself and why you should listen to me. My name is Dan Malone. I spent 4 years working with PricewaterhouseCoopers, who are one of the biggest financial services firms in the world, specifically in the asset and wealth management division. Now, what that means is that my day-to-day job centered around investments and auditing some of the largest investment managers in the world. I am professionally qualified as a financial advisor, chartered accountant, and chartered tax advisor here in Ireland, and I also have 2 business degrees from University College Dublin, one being a Bachelor of Commerce and the other being a Master's in Accountancy. For the past 2 years, I've spent most of my time creating educational finance content in the hope of making a difference in people's lives by improving their relationship with money. So if you do enjoy this guide and want to see more straight talking finance content in the future, I'd highly encourage you to subscribe to the channel. So, what is investing? Investing is the act of buying assets with the expectation of profit. These assets are known as investment assets. Investment assets can be anything from company stocks to residential property to commodities like oil and gold. You buy these investment assets with your money in the hope of earning more money. The investment assets that we're going to be focusing on are company stocks, and there's a couple of reasons why that is. Number one, historically, company stocks have provided the best investment returns to investors over long periods of time. In other words, when you compare the profits from owning company stocks to the profits from owning other investment assets over 20, 30, or 40 years, the profits from owning company stocks are typically larger. Number two, it's very easy to buy company stocks. There are lots of apps that allow you to buy company stocks from anywhere in the world. That makes it as easy as online banking. Because of these apps, buying company stocks has never been easier than it is today. And number three, you don't need a lot of money to buy company stocks. Investment assets like residential property require minimum deposits that can amount to tens of thousands of euro. Anyone who has ever tried to buy a house will know this. Company stocks, on the other hand, can be bought for as little as €1, making them accessible to anyone and everyone. With that being said, what are company stocks? Let me preface by saying that there's no difference between company stocks and company shares. We normally use the word stocks when we're talking about investments in companies as a whole or as a general premise, and we use the word shares when we're talking about our actual investment in one specific company. Example, I mainly invest in stocks. I own shares in Microsoft. With that in mind, I'm going to be using the word shares for the purposes of this explanation. All companies have owners, but how do you prove who the owners of a company are? The owners of a company are the individuals or corporations who own shares in that company, also known as the shareholders. The more shares of a company you own, the more of the company you own. So therefore, company shares represent ownership in a company, and when you buy them, you become a part owner of that company. So when you buy shares in Microsoft, Apple, or Amazon, you become a part owner of those companies. Now granted, there are over 7 billion shares of Microsoft in existence. So when you buy one share, you are a part owner, but you're the tiniest fraction of a part owner. But it's not the ownership that we care about. It's what the ownership represents. That one share in Microsoft represents 2 things. Number one, an entitlement to the net assets of Microsoft, and number two, an entitlement to the future earnings of Microsoft. Sounds complicated, but it really isn't. Microsoft has lots of assets. It owns property, it has cash, it has inventory, but it also has liabilities. It needs to repay its lenders any money it borrows. If Microsoft was to shut down its business tomorrow, all of its assets could be sold for cash. That cash would first be used to settle any liabilities that the company has. But once that's been done, any cash that's left over will be split between the owners of the company in proportion to how many shares they own. That's what what I mean when I say that you have an entitlement to the net assets of the company. In the event of Microsoft's closure, you would receive your proportionate share of Microsoft's assets net of any liabilities, even if you only owned one share. Now, what's really interesting is that at any given point in time, the minimum price that one share in any company sells for should, in theory, be equal to the total net assets of the company divided by the total number of shares, i.e. the proportion of the total company net assets that one share would get you in the event of the company's closure. This is known as the book value per share. Logically, if I told you that in the event of Microsoft's closure, you'd receive $200 as a payout for your share, you wouldn't sell that share to anyone for any less than $200 under normal circumstances. Why would you? You're guaranteed to receive $200 worth of net assets from the company, so there's no reason why you'd sell that right for any less. It's worthwhile noting that in the event of a company's actual closure in practice, the company could very likely be insolvent, and in that scenario, its liabilities would be larger than its assets. If that was the case, shareholders would receive no proportionate payout of net assets for their shares, because there are no net assets to pay out. So book value per share is just a helpful way to visualize the minimum price or value of a single share in a company at a certain point in time. The book value per share will change over time as the company increases and decreases its assets and liabilities. So when you buy shares in a company and the price that you pay is larger than the book value per share of that company, which it will be in most cases, that additional price is what you're paying for the entitlement to future company earnings. Now, obviously, we don't know exactly how much a company will earn in the future, but we can make an estimation. That estimation is based on a whole pile of factors: the past earnings of the company, the growth potential of the company's industry, how the economy is performing. Whatever the market decides is a fair estimation of the company's future earnings will directly impact the price of the company shares. The higher the estimation, the higher the price above book value per share that you'll have to pay to buy those shares. As a buyer, the more conservative the market's estimation, the better, because that will result in you buying the shares for a lower price. As a seller, the more optimistic the market's estimation, the better, because that will result in you selling the shares for a higher price. Ideally, you want to buy shares from pessimistic investors and sell shares to optimistic investors. So at its most simple level, the price of any company share is made up of A, the book value per share, which is the minimum price, plus B, an estimation of the future earnings of the company, with more optimistic estimates leading to higher share prices. The reason why I've spent a bit of time explaining what company shares are, what they represent, and how they're priced is because you need to understand those fundamentals in order to fully understand how you can profit. That brings us to our next question: how do you profit from owning company stocks? There are two main ways: capital appreciation and dividends. Capital appreciation just means an increase in the value of your stocks, i.e. the current company share price is greater than what you paid to buy those shares in the first place. Knowing what we know about how company shares are priced, what causes share prices to increase? Well, if a company increases its assets and decreases its liabilities, that will lead to a higher book value per share, which in turn can lead to higher share prices. Separately, the market's estimation for the future earnings potential of the company may become more optimistic. That in turn would lead to a higher share price. Other factors like the central banks reducing interest rates can also increase the share price of companies. The second way that you profit from owning company stocks is through dividends. Remember earlier on we said that as a shareholder, you're entitled to the net assets of the company. Well, in recognition of that fact, some companies will choose to pay you a sum of money as a reward for continuing to own those shares. This is what's known as a dividend. I say some companies because not all companies choose to pay a dividend, but for those who do, they typically pay it on a quarterly basis, i.e. once every 3 months. Other companies may pay a dividend on a monthly, half-yearly, or yearly basis, but quarterly is the most common. So you, as a shareholder, will make money from company stocks when either A, the share price of the company increases, or B, the company chooses to pay you a dividend. With that in mind, let's talk about why investing is important. The alternative to investing is leaving all of your money in a bank account, which is what most people choose to do. Now, whether they make that choice consciously or subconsciously, of course depends on the person. But for the most part, society has taught us that your money belongs in a bank account, and that's what most people, knowingly or not, choose to do. There's nothing wrong with bank accounts per se. In fact, we recently made a video talking about how bank accounts offer some of the best protection for your money, in the sense that when you put money in the bank, you can be confident that it'll be safe even in the unlikely event of the bank's collapse. The biggest problem with bank accounts is that they offer zero growth for your money. Yes, banks will pay you deposit interest for choosing to place your money in their hands, but the issue is that the rate of deposit interest which the bank offers is abysmal. You don't put money in the bank to make more money. You put money in the bank for safety. So why is it a problem if our money isn't growing? The answer to that question consists of one single word, and it's potentially the most important word of this entire video: inflation. Inflation is when everything around us becomes more expensive. Groceries, healthcare, energy, entertainment, everything that we consume naturally becomes more expensive over time. Some years, the rate at which things become more expensive is greater than others, but over long periods of time, we can expect the price of goods and services to increase on average by about 2% every year. So let's think about how this affects the money in our bank account, which isn't growing. It's safe, but it isn't growing. If I have 10,000 euro in my bank account today, I can buy a certain amount of pints of beer. Let's say, for argument's sake, the price of a pint of beer today is 6 euro. So with 10,000 euro, I could buy 1,666 pints of beer today. Now, if we agree that the price of a pint of beer will increase by 2% every year for the next 20 years because of inflation, then we can also agree that in 20 years' time, that same 10,000 euro, if left sitting in a bank account, wouldn't be able to buy the same amount of pints that it could buy today. In fact, you'd need an extra 4,859 euro in 20 years' time just to be able to buy the same 1,666 pints of beer. What's happening here is that your money is becoming less valuable over time. The number in your bank account hasn't changed, but what that number can buy you has changed. So the reason why we invest is to protect the value of our money from the effects of inflation. That's the minimum objective. Anything above that is a bonus. How we achieve that is by buying investment assets like stocks that will increase in value over time and pay us dividends. So if investing is so important, when should you start? Whenever I get asked this question, my answer is always the same. The best time to start was yesterday, but today will do. And there's a very logical explanation as to why that is. The numbers tell us that the earlier you start investing, the better your investment returns will be. One of the secrets to success in investing is time. The more time you spend invested, the better. And that's because time is what unlocks the power of compound interest. Compound interest is best explained using an example. Say you invest 200 euro every month for the next 20 years. You'd be investing 2,400 euro every year, and over 20 years, you'd invest a total of 48,000 euro. Now, if you didn't invest and left that money in a bank account, by the end of year 20, you'd probably have around 48,000 euro in the bank. A bit more when you add on deposit interest. But because you're investing in stocks, by the end of year 20, that 48,000 euro will have grown to over 109,000 euro based on historical averages. Now, let's say we double the period of time that you're invested for. Let's say you invest 200 euro every month for the next 40 years. By the end of year 40, you'll have invested 96,000 euro, which is double what you invested over 20 years, which obviously makes sense because you're investing for double the amount of time. But remember, after 20 years, your 48,000 euro had grown to 109,000 euro. So you might assume that because you're doubling the amount that you're investing from 48,000 to 96,000, that you can expect double the previous result of 109,000 euro after 40 years, which will be 218,000 euro. But what if I told you that after 40 years, your 96,000 euro won't have grown to 218,000 euro, but to over 621,000 euro? So by doubling the amount of time that you're investing for, you've increased your results by nearly 470%. That's the power of compound interest. And the earlier you start investing and the longer you spend invested, the greater its effects will be. What's actually happening in the background is that your profits from investing are starting to earn profits of their own. So your profits are earning you more profits. And that effect continues to snowball over and over and over again. In other words, it's not just the money that you invest which earns profits. The profits themselves will earn you even more profits provided you keep them invested. When you keep those profits invested for long periods of time, and I'm talking decades, the results are staggering. So I'm going to end this first guide here to avoid information overload. In the next episode of this series, we're going to talk about how you actually go about making an investment in company stocks using brokerage accounts. We'll talk about what the stock market is and how that works, and by the end of it, you'll have the tools needed to make your first investment. I hope you found this guide useful. If you did, you can show your support by leaving a like on the video and subscribing to the channel if you haven't already. If you have any questions on anything that we covered in this guide, please do not hesitate to leave a comment down below and I will answer your question to the best of my ability. Thanks very much for watching and I'll see you in the next one. Cheers.